Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. I must apologize, this is actually a redo of a video that we've already posted, and what we discovered was that we were having internet problems while I was doing the video, and consequently the FastGraphs in the original video weren't loading properly. The performance reports were actually showing a different name company, but still keeping the old performance. So we apologize for that, but this is a highly requested subscriber request series on the life insurance industry. And what I've done here is I've picked the top 5 life insurers, and I've limited this particular video to only A-rated companies or better. So we're going to be looking at Aflac, MetLife, Manulife Financial, Principal Financial, and Prudential Financial. And again, these are all A-rated companies, and I'm going to be looking at these one at a time and go through this from a standpoint of current valuation relative to historical performance and then relative to dividend safety. So to summarize, I'm going to look at valuation of each of these companies as far as relative to their historical norms and their operating histories. I'm then going to be comparing their performance to the market. I'm going to use the S&P 500 as my proxy there. And then last but not least, I'm going to look at the dividend coverage by looking at operating cash flow and free cash flow on each of these companies. So before I get started with the individual companies, however, let's start by looking at the actual S&P 500 itself for perspective. And what you see here is a graph going back to the Great Recession, 2008. And you can see the S&P had a couple of down years, and earnings the orange line in this graph, is a PE ratio of 15, which I would consider fair value for the market as a, foundational valuation. And you can see the stock price was kind of tracking that 15 multiple. And then we got into 2016 and 17, and we start seeing these higher valuations on the market. But the bottom line here is, and I want to make this point, when I compare the other 5 companies to the market, I want you to note that the market is overvalued relative to the PE. It's trading at a 20.54 blended PE ratio. It only has an earnings yield of 4.87 and a dividend yield of 1.98%. So the market is overvalued, and as I'll be showing you with these 5 companies, most of them are attractively valued today. With my first example here, I'm going to look at Aflac. Everyone knows Aflac by, of course, the duck. It's a life and health insurer. It has an A- credit rating and only 20% long-term debt to capital. The dividend yield, in contrast to under 2% on the S&P, is currently at 3.06%. Now, I'm using the same time frame here, but I do want you to notice that Aflac was overvalued in the throes of the recession, but then after the recession came, the stock price fell dramatically. So I'm going to cut a year off of this graph and look at Aflac when it was undervalued, but not at its trough undervaluation. And then I want to bring performance results in and let you see how it compared to the market when it was attractively valued to this current undervalued level coming out of the Great Recession. The first thing I want you to notice is Aflac paid less dividend income than the market, and it underperformed the market dramatically from a standpoint over this time frame of total performance in terms of capital appreciation, and even when you combine dividend income plus capital appreciation. And by the way, in all these graphs, I'm showing the dividends not being reinvested. They're being collected or gathered by the shareholders. So it was an underperformer during this period of time. And that's real clear by the fact that, the earnings growth rate was 6.27% during this time frame. The stock was relatively inexpensive here, and it's extremely inexpensive now. Now, the thesis for investing in Aflac today is because it is so undervalued and has such a higher yield than the overall market. I'll take a quick look at forecasting here. We're not expecting much growth, but if we get back to a normal PE, then the market, the opportunity for this stock would be pretty attractive. But keep in mind, as you saw in the previous historical graph, this stock trades at a sub 15 PE since the Great Recession. It's only been trading, and I'll just go back and look at that, at a PE in the 10 range. So here with the forecasting calculator, I'm looking at a PE of 10.79. That's the last 5 years. I can actually find or get pretty close to that 10.3 PE that we saw in that longer term graph. And if the stock just is currently trading at a blended PE of 8, so if it just simply, even with no growth, moved back, it would have tremendous upside. And again, in comparison to the market, this stock would be very, very attractive right now. Now, the next thing I want to do, since dividend is what I would say this is all about with its current 3% yield, let's look at operating cash flow. Now, I'm not getting forecast data from our data provider FactSet on Aflac, but I do want you to see historically this stock is traded about 4.67 times operating cash flow. It's currently trading at 5 times operating cash flow, so that's in line with, I'll call it, historical norms. But the real key here is not from a valuation perspective. The real key is I want you to look at the coverage of the dividend. The company's generating, over $7 in operating cash flow to pay a $1.08 dividend. So the dividend is extremely well covered. And let's look at that now from the perspective of free cash flow. And once again, we see free cash flow dramatically covering the company's dividend. So, I think from a standpoint of dividend safety, Aflac is very safe. The next life and health insurer that I'm going to look at is MetLife, another very famous one, A- rated, 20% debt to capital, very similar to what we saw with Aflac. Now, coming into the Great Recession, earnings were really under a lot of pressures as we entered that Great Recession. So I'm going to cut a year off of this graph, just like I did before, and measure performance when it was also undervalued. Note that the company had a 4.05% growth rate. It's currently yielding 5%. It's A- rated with 20% debt to capital. So let's look at its performance relative to the overall market. And in this case, the company, again, underperformed the market on total income, underperformed it on capital appreciation, and underperformed it dramatically as far as total rate of return. Because again, keep in mind, we're comparing an undervalued stock today to a very highly valued marketplace, as I showed you in the first part of this video. Now, if we go back down to about a 9 or 10 times earnings, again, this stock has been trading at around 9 times earnings. That's the blue line. The market's been discounting these financials, and life and health insurers are no different. But if we get back to a 9-ish PE, here I'm using 9.86. Again, I can get that down to that closer to the 9. I'll use the 9.1 here. Because again, these are all ish numbers. They're not meant to be perfectly precise. We would have very incredible long-term rates of return here with a good record of dividend growth. Because again, when I look at performance, I do want you to notice the dividend has been growing by, on average about 9.8%. And it's, had nice dividend increases going forward. Now, what it does with its dividend as a result of COVID is yet to be seen. Now, one of the things that I did as a sidebar here, I did read an article or report recently where they're saying there's been a surge in requests for life insurance as a result of COVID. But as far as the consensus estimates of these analysts, we're only looking for a 13% drop in earnings as a result of COVID for this year. Now, that could change, and that's something that needs to be kept track of. But anyway, MetLife looks very, very attractive at these valuations, trading at only 6 times its adjusted operating earnings. So again, let's look at operating cash flow. And just like we did with Aflac, I've got very strong dividend coverage using operating cash flow. And then let's go ahead and look at free cash flow. And again, I've got free cash flow dramatically protecting the dividend. So this is another example of a life and health insurer that looks reasonably attractive given today's valuation and the potential for it to revert back to the mean and move back up, into about a 9-ish PE. The PE expansion is a big part of the story here. My next company here is Manulife Financial, and this is an interesting graph because I want you to notice how earnings really suffered during the Great Recession of 2008 and 2009. Now, this is a Canadian company. This is trading on the Toronto Stock Exchange, and we're looking at this graph in terms of Canadian dollars. So, but to try to normalize this, I'm going to take out a couple of years of data here, and I'm going to try to get this down to where you can see this company for what it's looked like on more recent numbers here. And again, you see that earnings growth has been very strong since 2019. We are expecting about a 19% down year for this particular fiscal year, which does end in December, by the way. From a standpoint of performance, the historical performance has been subpar again, except for the dividend. They've actually outperformed the S&P on dividend income. But again, because of the overvaluation of the market and the undervaluation of this stock, they've dramatically underperformed it on a total on capital appreciation, but it has thrown off a 7% yield. Looking at forecasting here, and again, using a lower historical PE, here I'm looking at a normal PE of 12.05. So again, I'll go here and try to pick that number as close as I can. There we go, 12.05. And look at what would happen. Remember, these are what-if scenarios. What would happen if the stock did trade at a 12.05 PE or move back? The PE expansion virtually doubled, and we looked at performance. We'd have unbelievably strong performance going forward for the next year. Again, it's an A-rated company with only 6% debt and currently offers a dividend yield of 6.46%. So the point is, we're looking at still an overvalued market. By converting to these life and health insurers when they're undervalued, theoretically at least, the performance going forward should be a lot better than it has been competitive in the historical norm. So let's go back then and look at the company again from a standpoint of dividend coverage. So we'll go to operating cash flow first. And once again, we see great dividend coverage with cash flow. So these companies, all have been generating very strong cash flow. Let's look at free cash flow very quickly. And again, we have free cash flow substantially covering the dividends. So the dividends appear to be safe, or at least the companies appear to be capable of continuing to pay a dividend. But keep in mind, all of this is predicated on what happens going forward. Now, I did want to kind of close out this particular company and show you how different stocks can be and how different the market react. Prior to the Great Recession, this company was generating very strong and very consistent earnings growth, and the market was valuing it at a 15 PE very consistently. And then we had this collapse. So if I was going to look at this stock more closely, remember, these are all pre-research looks at these companies when I'm doing subscriber requests. I'd want to know what really happened to Manulife here, and then why the company has performed so well going forward. So that's something to think about when you're looking. So let's move on now, and let's go to Principal Financial Group. Once again, we see a very similar story, a low historical normal valuation, PE around 11. So 10 to 12 is what the market's been pricing these life and health insurers are, post the Great Recession at least. Let me shorten that again to kind of get rid of this high valuation and this anomalous data. So let's look at this from a standpoint when the company was at least fairly valued. It's back here now we had a PE ratio of 9. We're currently looking at a PE ratio of 7, so that's a headwind. Performance-wise, the company's performance during this time frame generated significantly more dividend income than the market, but underperformed it on a capital appreciation and a total rate of return basis. So once again, we see an example of a company who is fighting the headwinds of an overvalued market. But I do want you to see this company's had really strong dividend growth, although last year the dividend only grew by 3.8%, but it's been double digit, and you can see there are times when this company really pays out a lot of dividend income, and it's all relevant to their payout ratios, by the way, which are reasonably low for all of these companies. So let's move on to operating cash flow. Once again, my primary concern here are the cash flows covering the dividend. The white line, of course, is the dividend, and the answer is yes by a substantial amount. And I also want to point out their payout ratio of cash flows is 10 to 12%. So again, that looks very safe from a standpoint of the dividend coverage currently, unless things change dramatically as a result of COVID. Let's now look at free cash flow. Once again, I show free cash flow, covering the dividend like a blanket. So dividends look safe now, assuming that nothing really collapses too badly. And again, the estimates I have here are on things like earnings. And let's look at that real quickly and recognize that the analysts expect there to be, a similar drop in earnings for each of these companies that I've shown you here. However, we're not looking at catastrophic drops like we've seen with some companies in some industries. And then last but not least, let's take a look at Prudential Financial Group, another A-rated company, 21% debt to capital, currently offering a 7.11% dividend yield. It is expected to have a more severe drop in earnings than most of the others we've looked at, 23% for this fiscal year, which ends in December, by the way. So we are looking for damage to these companies, and you can see that the price does respond to that, but it's already responded in this case. So let's look at it from a standpoint, first of all, of how the stock has compared to the S&P. But I want to go back to that same time frame I've been showing and show that it was pretty, earnings did collapse. It was pretty overvalued. So I'm going to shorten this to that 14-year time frame and then compare the performance, trying to keep this apples to apples. Generated twice as much, almost, dividend income as the market. produced pretty good capital growth, doubled the money, but again, significantly underperformed the market over this time frame. And yet almost gave us a 10% rate of return compared to 12.5% for the market. But keep in mind, that's comparing it when it's extremely undervalued. If I go back to these more normal PE, and I'm going to use the 9.2 here, the rates of return for the next couple of years, if we did get a reversion to the mean, if the stock moved back up to these more, what I'll call more fair or more normal PEs, there'd be a lot of money to be made here. And you've got a 7% dividend, currently that, looks very, very attractive, ceteris paribus. In other words, as the old saying, as the economic term goes, all things remaining constant. Once again, dividend coverage is extremely good, looking at it from an operating cash flow and then looking at it from free cash flow. We once again see significant dividend coverage. Anyway, thanks for listening, everybody, and watching the video. This has been Chuck Carnevale. I really appreciate it. This is a subscriber request series. And as always, I recommend you do your own due diligence. These stocks look very attractive today. And of course, if you like what you saw here, if you haven't subscribed to my YouTube channel already, do that. But perhaps more importantly, if you really find the value in the FastGraphs research tool that we've developed here, you might want to take a look at a free trial at www.fastgraphs.com. It's free for the first 14 days, and it's a tremendous tool to help you make better long-term sound investment decisions. Thanks for watching.